Yogesh, in such vulnerable times where crude, dollar, global news is particularly so high, FI is on the selling side, how should one look to safeguard their portfolio? Because it's about saving capital in a falling market rather than making money.
Hi, good afternoon. Thanks for having me. Quickly, while the markets corrected about 15 odd percent from the highs of October 2021, and mid caps and small caps have given up a lot more, around 20 odd percent. If you compare this with the pre-COVID levels, say Feb of 2020, the market's still 30 odd percent higher. Clearly, there's a lot changed in 2022 from the start of the year. Inflation always was picking up, and there was a concern there. Ukraine war clearly didn't help, and it broke down supply chains. So now we are in an environment which is facing a lot more challenges, wherein the central banks have changed their stance on the policy. You're seeing rate hikes, tightening of liquidity, to control inflation, and the supply chain, which is broken down because of Ukraine war and COVID issues in China recently, is clearly having impact on multiple factors. This market situation, not very easy to kind of invest. Our view now is that one has to really look at a long term. In the near term, I would say next 6 odd months, you would see volatility come through as the central banks increase rate and till they get their inflationary expectations under control. So from now till next 2-3 quarters, you will see volatility play out in the markets, and investors will have to really stagger their investments over 2-3-4 quarters and have a better rupee cost average on their portfolio. From an upside point of view, if you look at market valuation factors, from a peak, it's come down significantly. Now it's down to averages of about 18 times forward earnings, which is good. But earnings correction is not yet started. We do expect corporate earnings to be under pressure. You have an upcoming quarterly results season. You will find there, wherein post this earnings season, we do expect analysts cut their expectations on corporate earnings, which will have its own impact on the stock prices as well as markets. So near term, cautious, building a portfolio over 2-3-4 quarters with a 2-year horizon is the right approach which an investor should take now.
Right. Good afternoon, Mr. Kalwani. This is Cheryl also joining in. And as you mentioned that we have to brace ourselves for some more volatility for at least 2 to 3 quarters. And also the fact that we may likely see a corporate earnings downgrade cycle also to begin. We are awaiting the Q1 numbers, which the Q1 will end by tomorrow, that is. So in this sort of a volatile situation, in such an uncertain environment, where should one invest in? Do you think that banks will take the market leadership ahead, or which other sectors do you see as a safe pocket to invest in?
So banks, we are constructive on BFSI as a space. If you actually see, has not done much, while the broader, a lot more parts of the other markets, the new age stocks and commodities and a lot more other segments outperformed. Banks is a segment which had underperformed even for the last 2-3 years. So from a valuation standpoint, clearly banks are attractively placed, private sector and even PSU banks. That's a sector in this volatility. We do definitely recommend investors to build positions into, as we are seeing good credit growth numbers. That could be happening also because of higher inventory being maintained by corporates, and that's increasing the working capital cycle, etc. So banks as a space definitely should do well and is a key addition in the clients' portfolios. Another few sectors which we feel will benefit from an inflationary environment is hard assets. So when I say hard assets, means real estate as well as raw materials. Those are the sectors which one has to focus on, and there will be opportunities in those areas. In this challenging time, one has to be a lot more stock specific and sector specific. rather than focus on the Nifty, because we do see the divergent trends emerging, and probably the Nifty or the narrow indexes will not really show dramatic returns, but on a stock level, and if one bets with good alpha managers, you would see outperformance playing out there. Another space which we feel investors will look increasingly going forward is fixed income space, the debt markets, wherein investment grade assets, instruments or issuers is something which will make attractive, because the returns out there will look more into double digit and a high 11 odd percent, 12 odd percent. So that's when you'll see a lot more flows into that sector.
Yes, Yogesh, and just quickly before we let you go, due to the paucity of time, just wanted to get a sense. You just talked about that fixed income will get increased allocation. Which are the other alternate asset classes that you're suggesting your clients at this point of time?
So REITs and InvITs, both listed as well as private, will make tremendous sense. They are hard assets. Real estate, like I mentioned, will do well in an inflationary environment. As we see rates move up, you would see real assets doing well. So REITs, InvITs, definitely. Private venture equity, I would say early stage company, you have seen a correction in valuations as the flows of funds have come off. So the early stage companies where the valuations had inflated are coming back to some normalcy. So one should look at venture investments into early stage companies. So those are two other pockets which we feel make sense from a client allocation point of view.
Yogesh, thank you so much for joining us with that holistic perspective on how to construct a volatility-proof portfolio at that. We'll let you go on that note.